On today's show, three questions. Number one, what's changing in economic data? Number two, is the short term rental loophole legit? And number three, why are we so scared of market downturn? Welcome to Dennis Money's 2 cents, where we help Dennis navigate all the noise. I'm Matt.
I'm Jake. And I'm Rabih.
Yeah, you are, but you are not only Rabih. You get another shout out, Rabih, 2 weeks in a row, because we talked about, was that last week we talked about the thesis defense? So you defended the thesis. We mentioned that it was the quote from the head of the board there, of the committee, that it was the best, one of the best defenses they've heard at the University of Utah, which is incredible. And then we find out today, we hop on and you casually say, hey, I graduated.
Yeah.
So you clearly defended that thesis like a knight defending,
Thank you.
I don't know, a castle, something, and you are officially graduated. So now we have to call you Master Rabih.
Yeah, I would love that. I would like to change my title officially to
Master Rabih.
I'm
So
just gonna run with it. Yeah.
I'm kind of bummed. I should have, if I would have known about your graduation, I probably would have come and brought flowers or something.
It's fine. It was cool. It was a short, sweet ceremony. It was only the master's and PhD students. It took like 45 minutes. I was dreading the long speeches, but none of that happened. So it was fine. It was
quick,
enjoyable.
Cool. Well, congratulations for real. Super excited for you. I know the team's excited because we have 100% back of you now, or 100% of you back in the back in
on
the
Wednesday. Actually, I usually leave on Wednesday early just to catch class. And last Wednesday, it was like 4:30, and we're still sitting there and chatting.
And you're like, this is amazing.
This feels different. I haven't done this in a while. It was good.
Yeah. Well, let's jump in. Rabih, number one, what's changing in economic data?
I'm probably more excited about this than my own graduation, just saying. But I've been like teasing it for a couple of weeks now that we are not getting any economic data, any meaningful economic data. And this week is a big one because we'll get GDP data, we're going to get unemployment data, we're going to get inflation data. Those are the three main data points you need to assess the direction that the economy is going through, which is it was a holiday for me. It was great. So on Wednesday, we got GDP data and as well as inflation data. And today we got unemployment and payroll. So let me walk you through them. And now let's empty our cups, forget what happened in all of April and all what's the beginning of the year. Let's look at this economic data as if its latest reading, and let's see where does this put the economy. And then we can go back to what we know and see whether there's a mismatch or we're heading into the right direction, etc. So let's start with GDP. The Q1 2025 advanced estimate, because they issue like 2 or 3 estimates for GDP until they finalize the quarter. We got the Q1 advanced estimate, and it came in at negative 0.3% on an annualized term for that quarter. So if you guys remember, before this data point was issued, we were tracking the Atlanta Fed Now GDP tracker, and it seemed like people and businesses specifically were rushing ahead of the April 2nd deadline and mass importing, filling up their inventories, and just because they do not know what would happen after April 2. Mathematically, the fact that everyone's rushing and doubling down on their imports is bad for the economy and GDP. And the Atlanta Fed estimate was like, it's going to be a bad quarter. We might be down as much as 1.8%. If you annualize it, this is going to be the first leg of a 2 consecutive quarters, declining quarter in GDP, and we're going to be in a recession. The data came in, and it was only a negative 0.3% annualized. So it's actually, you divide that by 4, which, can we make the case it's a rounding error and the economy was flat?
Yeah, basically flat.
It is a good sign. So it is negative because the Q4 we grew at 2.4 annualized, and now we're shrinking at 0.3 annualized. It's still like, a slowdown, but it's not as big as what we expected, which is healthy, which is a good sign. Something, and part of a hot take maybe, this data point provides really strong confidence that we might not even have a recession. Q2 will be fine because the impact of the imports on Q1 was that it throws them into the negative territory. But the imports are a one-time thing. It's not going to be happening every single quarter. People wanted to mass import and fill up their inventories right before the April 2nd deadline. So now the thinking in Q2 is like, oh, we already imported last quarter. We do not need to import now. Let's see how it pans out. So the fact that they increase importing in Q1 means that they're gonna probably decrease importing in Q2. And decreasing imports in Q2 actually has the opposite effect, which is going to increase the GDP. So now, instead of us knowing that there's an economic behavior that might dampen economic activity, now the lack of import might actually improve economic activity. And in that sense, if we are only treading the waters around 0.3 up and down, which is very close to zero, the fact that we might not be importing as much in Q2 might actually give us a positive GDP print in Q2, which means no recession by the textbook. All good. That was what we saw from economic activity. Do you guys have any comments before I move to the next two?
I mean, just kind of what we've talked about a bunch, which is the story is just not the severity of the story we're hearing is not bearing out in the data. And it's just, which is normal, and or especially normal with what's happening politically, the political climate. So again, nothing else to really add other than just another reminder that it always feels scarier than it actually is.
Yeah, something I've been thinking about recently with this whole tariff and import situation is we are very worried, it seems to be, or very up in arms about what could happen or what may happen, right? And I just feel like as you're running your own life and, you talk about your finances or just everything else, it's hard to get yourself too worked up, I think, about things that may or may not happen. We just don't know. Like, I wonder, like, can we just all switch our mindset to be, we will worry about problems when they happen, when they actually become actual problems?
Yeah. Well, and it's a great point, Jake. And also not only that, and I'm going to say something that is like probably just so out of touch, and so I'll just acknowledge it on the front end now. But I think about this a lot of like how much of like complaining you hear online or this doomsday, this and that online. It's it's always like social media and just people love to complain about and catastrophize these things that are happening. But how much of it is actually impacting your day-to-day life? Like, right, like I think most people, I don't give a crap who's president or what's happening politically. Most people are just living their life, right? And it's not actually having an impact on your day to day. Now, again, I'm saying that, and there's probably people yelling right now at this, but I really just would, if that is the case, that the things that are being said online, or again, the catastrophizing of it all actually is bearing out in real life. Like, I'd love to see examples of that right now, I
Yeah.
guess.
And everyone keeps telling me, just wait, just wait, just wait.
Yeah,
Right?
it's
These things
always
like
just wait. It's getting worse. It's going to
it's
get worse.
going to get worse, it's going to get worse. And sure, I can understand that happening. I just wonder if we get too up in ours about things that may or may not happen again. Just like the experts you said, Rabih, we were expecting this slowdown in GDP. Even people with really smart people with really good math were predicting a downtrend here, and that still didn't prove out yet to happen in Q1. And so I always just feel like let's deal with problems as they come type of when they actually come to fruition, and we can deal with it then. I don't know how much benefit we get as a species or as humans by worrying about problems that may or may not happen in the
Well,
future.
and especially, and then we'll get Robbie in here because now, Jake, it's become you and I just having this back and forth. But I think especially, so I'll kind of reiterate my point there because I do want to be obviously very clear and empathetic that, like, I'll just give examples. Like, there are people just with the first 100 days of Trump's presidency, like, have lost their job directly because of him. Like, he's cut jobs. So I don't want to be out of touch and say, and not empathetic to that kind of thing. But I guess to your point, Jake, I guess where I get a little bit numb to this stuff is like the doomsday scenarios. When I hear this, like the world is ending, this whole, this massive complete shift is going to like upend everything and America's going under. Like, I guess that kind of rhetoric, I'm kind of just like, how is that helpful? Because it's not real and it's not helpful. I guess that's kind of what the main point I'm emphasizing. Like, I know lives have been impacted and that needs to be acknowledged, but just the doomsday scenarios is kind of where I'm kind of like, okay, let's move on. Let's get Robbie in here. Robbie, what are your thoughts? How out of touch am I?
No, you're right. I think for survival reason, we only focus on the bad outcomes. Like probabilistically speaking, the good outcome is as likely as the bad outcome. A great surprise of euphoria where everyone suddenly becomes worth $10 million tomorrow is as probable as the world ending tomorrow. Those two extremes are there. but we try to focus on one versus the other due to human nature.
I think that's good. I'm glad that you brought that up, Robbie, that survivorship instinct I think that we all have as humans, where that's probably why we're always, okay, what is the next threat? What's coming up in the future that I have to prepare myself for? That's ingrained in a lot of us, I think. I just don't know how helpful it is when you're managing your own finances or your business. It's like, it's not really helping us, I don't think.
I think it's helpful. I think it's helpful to acknowledge that we all fall prey to that, right? And acknowledge and be aware of it, but it's not helpful to give into it, right? To your point, Jake. There's actually an amazing book called Factfulness by a guy named Hans Rosling. Anyway, I would highly recommend reading it, but he talks about this very thing, Robbie, to your point about like the probabilities of things. And he goes through this whole thing of like all the areas of our, and he talks on a kind of a global scale, going back like 200 years to today. Like life is categorically across the board, data supported, better than it's ever been. And it will continue to always be better. And then highlighting how we just don't notice that. We just don't notice the slow progress. We're always noticing or kind of clinging on to that survivorship type thing of like the negativity. So we went down a rabbit hole there, but hopefully it's helpful, Robbie. Let's go back to you in the studio.
Yeah, I don't know how to tie this to what I wanted to talk about. It's a mistake inviting you, but I'm just kidding. So that was the GDP data, and it shows that there's kind of no change in the growth for this quarter, which kind of lessens the odds of a recession next quarter. Now let's look at what unemployment data came in as and what inflation is. Inflation that we received, inflation is actually based on March. That's the only one that's still based on March. We got the core PCE, and core PCE again is that exact number that the Fed said we wanted it to be at 2%, and they don't mind taking their time getting it to 2%. The interesting part about it, it kind of came into expectations, but it came at its slowest sprint ever since, CPI was 9.1 in July 2022. We got core PCE at 2.6 annualized. So only 0.6 away from the 2 target that they have. It was actually increasing October, November, December, and then February. January was a blip, but February it was up. Like in February, that number was 3% annualized, the core PCE, which is not as good as they wanted. Now in March, when you roll them over, we're at 2.6. That was helpful. That data came on the same day with the GDP, so it was a mixed signal whether the market liked it or not. But overall, on Wednesday, the markets were up. Markets liked it. What we are now getting is that economy is kind of flat, not in a recession. Inflation is coming down. So now all we need to make sure is that unemployment is not going up. And in that sense, you have 3 strikeouts where you confirm that we're not heading into a recession just yet. And that is what we saw with the unemployment numbers that we received over the week. We received multiple data points. Some of them are like how many jobs are available into the economy. We got this on Tuesday. And just this morning, we got the payroll and unemployment rate. In terms of the jobs available in the economy, so previously we were at 7.48 million jobs available, and we now moved a little bit slower, but we are at 7.2 jobs. So we kind of lost 200,000 jobs from the outstanding number of jobs. And this is still a healthy level. Number of jobs available has been increasing. At some point, it was like 2.5 jobs per every employed person. And now it went down to around 1.1. So the labor market is in balance, but the number is still available. If we have an indicator of a recession, the available jobs would suddenly disappear, and then they would start firing people. Right? There's still a good number of available jobs, and that 200,000 number is very interesting. And for this following reason, we got the job payrolls for April so far, and the non-farm payrolls, which is how many new jobs were added into the economy, was 200,000. So the decrease in the amount of available jobs didn't happen because employers decided to remove these vacancies. No, they were filled with people who got hired. So this stabilized the unemployment rate at 4.2% where it has been. And that is actually very healthy. Just telling us that the economy is not going as down as we thought, and we might bounce back pretty well in Q2 simply because it was an import effect. This also tells us that inflation has been dropping, and now it marked the lowest number it has since they started attacking the core PCE number. And it is telling us that there are jobs being created and people getting employed, stabilizing the labor market. If you just look at these data points, you will not, think that this is happening at the same time where there's a chat about a global recession related to supply chain disruptions and tariffs across the board. It does not look like that. This is all our good data. We're going to have to follow it to see. The only remaining data point that we'll need to look at after these three that I mentioned is actual retail sales, not the consumer sentiment, but actual retail sales. And if retail sales are there, this is a very healthy economy heading upwards, just based off the data. So let's wait and see. And
When do
that's
we
good.
get retail sales?
It comes out every month. We just had it 2 weeks ago, so in like 2 weeks from now.
Got it.
Good
Jake, you're
stuff.
making me yawn, dude. You're getting me
Sorry,
tired.
I don't know why I'm yawning over here. Yeah, this is all, I mean, that's good signs. Everyone should want the economy to be in a good, healthy spot. That's good for all of us. We should want unemployment low, spending to stay high. Yeah, it all sounds great. But that's not the vibe I'm getting. I was talking to my wife this morning about, oh my goodness, do we need to stock up on food storage type of stuff because tariffs and things are coming down the road. So it's hard to balance those two things.
It is hard. It is hard to balance those two things. Again, disconnect. That's the word of I think 2 cents over the last quite a while. It's just like disconnect. Also, the other thing I was thinking about, Rabih, is you're going through this data of just, do we just not give enough credit to how like resilient the economy is? Like,
well, I wonder,
right?
does nothing break until people start losing jobs? Like, as long as
Yeah.
people are earning a paycheck, they are going to spend that money, and we're going to keep all of our industries
I think
afloat.
that's it. That's it.
Right.
Rabih said that before. Like that's it. As long as the labor market's strong, that's the ripple effect across the board.
Because it creates a chain effect, right? Once you're fired, you don't have discretionary income, and this is what supports the economy, our spending. I just have to say that data might still turn sour. But it turning sour from this point is much more merciful than it turning sour from a point where we're at a brink of a recession, as the stock market was trying to indicate by it selling for 20% and recovering. We might start seeing, I don't know, our Amazon bill become higher just because now there are more tariffs. We might see these stuff. But given the current state of the economy, it gives you more confidence that maybe our pockets and companies' profit margins might be able to stomach it, versus then it creating a chain effect where we have to deleverage, fire people, and have to try to get ourselves out of this through an interest rate cut. And by the way, the data that we received this week is not an indicator that interest rates will be cut anytime soon.
So maybe our boy Jay Powell, despite the pressure put on by Trump, knew something like, hey, we're going to just pump the brakes a little bit, not lower rates yet, because
Probably,
he
but on
remains
the other
data
side
dependent.
of the coin, it's true. He knew something, but probably there's another side of the coin that he got lucky and the data was in his favor, where he said, oh yeah.
Sure.
Because imagine if it was bad, the tweets coming his way would be much, much stronger.
For sure. Awesome. Rabih, anything else? Any other updates on that? Or Jake, any other comments? Good to go. Great summary from our master, Rabih. Okay, let's jump into something. This is not necessarily from the news or anything, but just something that's actually come up with me personally just recently. It's funny, Jake, you probably have this too, where things come in waves with clients. I feel like all of a sudden you hear about a topic and all of a sudden you'll hear about it 7 times in the same week. Now part of that is maybe because they're on the same forum or like obviously news related, whatever, but this was kind of just like random. And because I even asked the people every time I heard it, I was like, are you getting these from the same source? And it was like it was always a different source. But the topic is the short-term rental loophole legit? I've had this brought up to me several times in the last few weeks from different sources, different clients, literally just asking that question. Is the short-term rental loophole legit? So I've done a bunch of research for clients to answer this question, not only just online and kind of going through it, but also talking kind of boots on the ground CPAs. So had multiple conversations with CPAs. I guess let's first, Jake, have you been asked this lately or at all about this very thing?
No, I haven't. So this is why I'm actually intrigued by what you're about to say here.
Okay, perfect. Well, so let's break down first what it is. I think just kind of explain what it is for people if you're hearing it for the first time. So kind of backing up real estate, as we've talked about many times, and I think most people kind of probably know just generally that real estate has different tax considerations than, let's say, the stock market. And so when it comes to real estate, there are certain situations where you can offset losses in real estate against active income. The default for real estate, whenever you take a loss, just like for like, let's say the stock market or like a stock asset, the default is it's a passive loss. So you can't offset that loss for tax purposes against, again, what we'd call active income, let's say like W-2 income. There are some quote unquote loopholes. So there's two. The first one is that you become a real estate, what's called a real estate professional. And there's certain benchmarks and things you have to hit, material participation in real estate. You have to have so many hours. You've got a lot, like all this stuff. That's number one. This is number two. Number two is the short-term rental, again, what they're calling a loophole. As one CPA I talked to the other day said, it's not a loophole, but that's what they call it. It sounds fancy when you call it a loophole. But what this basically means is, again, rental property losses, if you fall into this, will be considered active losses with a short-term rental that can be offset against active income. But like anything, there's a caveat. There's certain things you have to meet. So I'm going to stop there for a moment and just, does that make sense? And any of the questions you guys have on that yet?
No, I think you explained that well. I might have some thoughts after. Keep going for your next part
perfect. Here. So here's how it works. There's some stipulations. There's kind of like a few different things. There's three main things you've got to kind of meet on paper. So number one, the average stay per guest for be considered short term has to be 7 days or less. So think Airbnb, VRBO, right? Material participation test. So you, and let's emphasize you, cannot be a property manager, has to materially participate. So there's a couple of different ways they look at this. You have to have at least 500 hours active participation in this business, and you have to spend at least 100 hours more per year than anyone else. And like they track this. You have to log hours, you have to maintain like work logs, your cleaning, communication with guests, the maintenance that you like. You can't have a property manager do this. You have to do it. This also has to fit what's called a basic services test. So you can't be running a hotel. You can provide things as it says right in like the guidelines. You can provide linens between guest cleanings. You cannot offer what they designate as like hotel-like services. So daily cleaning, meals, concierge. Those are the main things that you have to meet. So you might hear that and on paper, you're like, this sounds reasonable. No big deal. This is how my clients have kind of said it. Like, yeah, we can do that. Then I talked to some CPAs and they're like, okay, there's the paper, what it says on paper, and then there's reality. And the CPA I talked to earlier this week, he goes, I currently have 3 clients right now who have brought this up in the last few weeks, who are doing it, who have done it over the last year or two. And the word he used is nightmare. He said all 3 of them have described it as an absolute nightmare. From the amount of effort they have to put in, the work, the stress, the condos or houses are being trashed. They're running it, right? The communication with people, it's become another job. Right? The other thing I'll say really quick, and I want to get your guys' thoughts. So how this actually works, and this is kind of, I think understanding this is really critical, because what happens is, and I think this is really misunderstood, is you would get a condo or house or whatever, you VRBO it, let's say you meet all the standards. What you do then is you do a cost segregation study, and you take massive bonus depreciation in that first year to offset against your income, right? So let's just use some quick examples. You buy something for $500,000, you cost seg it. You can do, let's say you do $350,000 in that's been segregated in that segregation study that can be applied to bonus depreciation for that year. You just took $350,000 and offset your income. That's massive, huge, but that's it. That's the year. It's done. Now you've got this property for who knows how long. Then you go to sell the property. Guess what the IRS does? They recapture the depreciation. So you are taxed on it anyway. So I'm going to stop there. I'll get you guys' thoughts. Go ahead.
I was going to go, I don't know if Rabih has any. I'm so happy you brought this up, Matt, because no, I haven't been getting any questions about this quote unquote loophole, right, recently. But I do get real estate tax questions all the time, right? This is a big thing where people just hear it on TikTok or from wherever is, okay, I want to save on taxes. How can I do this? Real estate is a big one. I like viewing this in the context of a dentist and maybe a practice owner where everyone's like, oh yeah, I can get 500 hours and put that towards active participation in this real estate property. That's like 10 hours a week, 10 plus hours a week that you have to put in. That is not nothing. If you are already running your own business and being part of a family and have all these other things going on in your life, I think most dentists we talk to are pretty slammed. And the life's currently finding 10 hours a week and trying to justify that amount of work is quite a lot. So yes, and it's like you said, it's like, okay, we'll get this huge tax deduction this year, but now we own this rental property moving forward that we got to work on. And people ask, well, that's only a 1-year tax deduction too.
1
It's like,
year.
now moving forward, everyone hears about like, I'll just keep buying real estate, never have to pay any tax. Well, that's you just buying a different property every single year
And
doing
then
it.
upping the amount of effort and time and energy it takes to run that. Yeah.
Yeah, it's just, yeah, I like that funny, like they call it a loophole. It's not really a loophole. Those are just the rules that's just the IRS code. Yeah, it sounds great in theory, or maybe on a 60-second TikTok video that you hear, it may sound amazing or something like that. But in practice, I just don't know how well it truly works I mean, this is also comes to think like, I don't think you should buy an investment just for the tax purposes, right? That's letting the tax tail wag the dog here a little bit, where you should be buying an investment or a short-term rental because you feel like it's going to make you money over time and be a good investment for you over time, not just to save on the taxes. If you're doing it just to save on the taxes, I feel like you're going to be a bit disappointed after that first year when you realize how much work this takes. And again, if you're like, oh, this takes a lot of work and I want to sell it, you're just recapturing all those taxes later on anyway and having to pay all those back. So yeah, I don't know. I don't want to ramble here, but it feels like I'm happy you brought it up. It seems like an awesome strategy in theory, but in practice, I think is harder to execute.
I just thought of something, but Rabih, I want to hear your take on this.
Yeah, I want to just get some clarification. Are those two separate things? There's the depreciation tax incentive that once you resell, you might pay on the back end. And then there is this, between quotations, the loophole that if you have a rental loss, you can deduct it from your tax income. So there are two separate things.
Yeah. I mean, guys, go ahead, Jake.
If you're like a real estate professional putting in the hours to meet the requirements, every single year you can offset losses. Like if the property is producing losses, you can use that to offset your taxable income each year. The problem is you're losing money on your real estate rental property, right? It's like you're saving taxes, but now you are losing actual thousands of dollars every year. So you'd rather make money and pay the taxes.
Yeah. So yeah, go ahead, Rabih.
No, the 2 cents that I have are that it seems like there is a clear line for the tax treatment for investors versus entrepreneurs, right? I'm really thinking of it from the perspective of an investor. In the stock market, if you have losses and you do tax loss harvesting, those do not immediately offset your taxable income. Actually, they only offset up to $3,000 if you're married, $1,500 if you're single, right? So if you are an entrepreneur taking on risk, actually putting in the hours, logging, etc., whether it's an investment company, real estate company, or any type of business, yeah, you should be able to have these massive tax incentives that in this conversation we're calling them loopholes. But if you are an investor who are hiring stuff, the amount of effort wouldn't equate. It would be a different type of investment. It makes sense to me. I don't know why it's getting mixed up. If you are putting in the work, if you're being an entrepreneur, you're going to have a different tax treatment than if you're just an investor who's passively waiting to appreciate or to provide you with income, dividend, rent, etc. So yeah, it really depends on the lifestyle you want, entrepreneur or investor.
It does make sense, Rabih. I love the framing that you just gave there because it does make sense, and it's set up for it to make sense in that in that lens of saying, yeah, if you're actively participating and investing, the government will incentivize you to do so. I think that I'm again glad you framed it because where people are trying to use it, maybe where it falls under loophole, is they're trying to maintain passivity, like being passive while getting active losses as an investor would or an entrepreneur would. That's where people get in trouble. The other thing I was thinking about, Jake, as you were going through it, this kind of just hit me. So the example I just gave, of the $350,000 in bonus depreciation, but you have to document and show 500 hours, like you said, that's 10 hours a week. If we look at this, if you just look at this as a trade-off, right, of time, energy, and money, and let's just say every dentist out there, every person out there has a value of their hour, like of an hour, right? Like your hour is worth something. And a dentist hour is worth a lot more than the average person. That's whether you're working or you're not. Like your hour has a value, and it should. And you should get really clear on what that hour is worth. So let's just do this. I think a really high producing dentist, let's say, I mean, well, just throw a number out. I'll let you guys throw a number out. Like, what do you think a dentist should say is an hourly kind of a value of their hour?
Okay, well, I got to back into this maybe a little bit here. Let's say you're working 4 days a week, 8 hours a day. Maybe that's on the low end of what you're working, right? That's 32 hours a week, and then times by 52, 1664, da, 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 da. Sorry, one sec. This is great podcasting, me typing on my calculator here.
I
Like
have a range.
$250 an hour?
Yeah, I would even say more than that.
Maybe
But
more?
I'm with you. Like
250, 300 an
the
hour?
range that I would give a high producing practice owning dentist, because I'm thinking of this not as an associate, but like your contribution as both a dentist and a practice owner, like running a business. I thought 500 to like
Sure. Yeah.
$750 an hour.
Yeah. Depending where you're at. Yeah.
So
Sure.
let's just go with first 500. So let's say $500 an hour, 500 hours that you have to put into this. That's $250,000, right? In value that you're giving to, let's say, receive a pretty sizable multi six figure depreciation.
If you're saving, like in your example, if you're getting $350,000 offsetting your income with that, you're saving about $100,000 probably in taxes.
Sure. Let's say it's $750 an hour. Now you're talking $375,000. The numbers don't necessarily matter as much as trying to get the point across of saying your hours are worth a lot of money. And like your stress, the energy, the time that you're putting into something like this to get this benefit. Like, I just think dentists kind of just think, how do I do whatever I possibly can to lower my taxes? The same CPA, one of the CPAs, well, a good friend of ours, I love what he says. He says sometimes he'll tell clients, you want to lower your tax bill, you can just pay me more. Just give me a higher fee. I'll triple my fees. And guess what? You'll pay lower taxes, but you just gave me money. And when they think of it like that, they're like, oh yeah, now I understand the trade-off. Like, understanding that saving money on your tax bill is not always, in fact, a lot of times, not a net positive to you. Rabih, what are any other thoughts on this?
No, I liked it. It's just adds a layer of common sense. Like most of the time when you get savings is because you have a loss. Whether it was you took a risk and you have a loss or your assets value is going down. Jake always says it. You should be happy that you're paying taxes, not overpaying taxes, but according to what the tax code says, because this means that you are in the direction of growth.
Listen, I get it. I know for the dentists who are listening to this, who are paying a lot of money in taxes, I get it. It stings. It really does hurt. Like, I actually think one of the smartest things the IRS ever did was, for most Americans, they just take taxes directly out of their paycheck. So you don't even notice it, right? It's like, that's why a lot of Americans don't even feel the sting there until they get to tax time and they have to pay some. Being a business owner where you're making quarterly payments, that was money that's deposited to the operating account, and you then have to pay it. That stings and hurts a lot more. Where it's like, I saw this money and now I am giving it. And if your practice is successful, that can be quite a lot of money, right, that you're paying in taxes. I get it. It is a bummer. We want to minimize taxes as much as possible, but I would just, in general, never purchase an investment solely for the tax savings. I think that's a wrong way to look at it. It's just like buying a dental practice and being like, I don't want to make any money and take a loss so I can save on my taxes. It's like, no, why? You want to buy a dental practice to produce income and money that you will then use to pay taxes anyway.
Yeah, no, and I'm with you, Jake. We truly are. Like, we see this all the time. Like, it does suck. We see the tax bills. We see how much money goes to taxes. We ourselves, even though we're not on the same level of a lot of our clients, it sucks. Like, it's painful when you see your tax bill.
Yep.
Especially the more money you make, the further in your career you get, your tax bill goes up. Like, we're not saying it doesn't hurt. I think the main point I try to get across to people is, don't miss the forest for the trees. Like, don't always take a step back and be thinking about the bigger picture here, and think about the trade-offs that you're making for one acute pain that, yes, needless taxes we should try to avoid for sure. Do what we possibly can. But as Rabih just said, a lot of times when you're lowering your tax bill, it's because you lost money. That's not a good thing. That's a net negative. You don't want that. You'd rather make that money pay your tax and be left with what's left over. I've said this many times and I stick by it. A tax deduction is always a net negative to your current self. Always. And the only tax deduction that you can take and still maintain the money for your future self is a retirement account and or HSA. Everything else, but it's still a net negative to you because you can't have that money to use, to spend. Everything else, every other deduction, net negative to you, always. So I want to make sure that that's clear. Is like this trade-off of a lower tax bill is not always a good thing.
Yep, you can either choose, do you want to lower your taxes or have more money in your pocket? That's often the discussion. And some people, I don't agree with it, but some people hate taxes so much that they would opt for the latter, honestly. They're just like, I would rather pay less. I just hate taxes so much.
And I think part of it too is it's a hard conversation to have. It is. I'm sitting here telling you it's a hard conversation to have, to tell a dentist this exact thing. Like, hey, you might just have to pay your taxes. But and I don't blame them, where they get wrapped up in this thing is salespeople. And we've said this before, that lie to someone who wants to be lied to. And they're taking advantage of that, trying to get you in these horrible strategies that they don't highlight the trade-offs here. They're just saying like, yeah, we're going to lower your tax bill. And I don't blame them. Dentists make a lot of money. They want to lower their bill. So anyway, there's the short-term rental loophole. Let's move on to the last topic here. Let's jump back here to the doc. Jake, why are we so scared of market downturns?
Okay, we're bouncing all over a bit here, but I like this. We're hitting on a bunch of different topics. As of now, the S&P 500, kind of the stand-in for the U.S. stock market, as of today, we're down about 3% on the year is where we currently stand. We've had a huge recovery right since that bottom where the market went down about 18%. I think we are back up essentially 15-ish percent, 14, 15% this month, really since the beginning of April. So we had a strong rally back. I want to just point out that for the people listening who, again, still maybe getting the news that things are really dire right now with where we are in the stock market, pretty normal territory for where things are. Just to clarify that point real quick, so I want to get into some other things, but pretty normal with where we stand in the stock market. Again, we'll see where things lead here over the next couple of months. The market could go down, and that's what I wanted to focus on. So like right now, we are not in bear market scary territory, but let's just say, for example, we have another dip where the market goes far lower than it is now, let's say over the next couple of months, over the next year. I just wanted to touch on a point that we've talked about in the past of how to deal with these down markets, kind of what's a good way to reframe how you think about it. So I think a lot of the time, the reason why we get so scared and so worried about bear markets when the market's going down is we open up our phone, we see like red blinking lights of, oh my gosh, your account's going down. I had $200,000 in my account and now I have $180,000 in my account, or 170. And in our minds, what we're thinking is, man, I just lost 30 grand. Like I saved a lot of money last year and that's all wiped away. I saved it all. It's all gone. My money is lost. It's going down. And I think many people just have that straightforward bet with the stock market where when it goes up, it's good. And when it goes down, it's bad. And I'm just betting on that. If it goes up, that's great. If it goes down, I'm a sucker. I lost money type of thing there. I think a helpful way to reframe or to maybe deal with market downturns is to view investing as a game of asset accumulation, right? Rather than the price, which actually is like the purpose of all types of investing. For some reason, this is easier, I think, to understand with other forms of more tangible assets. Like you will hear all the time, real estate investors say, I want to get to 10 rental properties. Right? Like that's their plan. It's like, I just want to get to 10 rental properties, my goal. And they don't really talk about the price of those rentals. It's just my goal over the next 20 years or so is to get 10 rental properties. And that makes sense. Or if like maybe a dental practice owner is like, my goal is to get to 2 to 3 locations. Like I just want to get to 3 locations, expand my empire here. And they don't care kind of what prices they're paying along the way to get those assets. That makes sense to people. Yeah, I just want to expand, buy more, as much assets as possible.
Or if anything, they are excited for a lower price.
There you go. Like, oh, I would actually love for the housing market to go down. Let's like increase interest rates or whatever. I can get into some cheaper houses. This same concept does apply to the stock market. It really does. So when you are buying, when you put money into your account every single month, whatever that amount is, you are buying shares of companies. These are real companies. They have real people working for them. They are physical assets you are buying. They have CEOs and boards and they provide value. And these are real things that you're buying. And so I think if we can view it that way, like, oh, I just want to accumulate rather than whatever the balance of my account is, every single month I am buying assets. I am buying shares of companies. And my goal over the next 10, 15, 20, however many years is, can I buy as many shares of these companies as possible? I wonder if that would help a lot of, framing it that way would help a lot of people be like, wow, that makes sense. Like, I actually want the market to go down. That if the market goes down 10, 20%, I can buy more shares. Like my $5,000 I'm putting into my investment account buys more. That actually kind of changes your thinking of, oh, this is actually pretty good for me. I'll stop there. Thoughts from either of you?
Love it. Rabih has got thoughts. I'm going to let him
No,
go.
I love it. He's saying, I do not know if this is helpful, but as he's speaking it, I pulled up my calculator. So I'm pretty sure it is helpful. And I was like, okay, let's say I want to get to $5 million. And for simplicity reasons, I just looked at the S&P 500 SPY ticker, and it's around 550. So I chose $500 for its price and divided it, and it says 10,000 shares. And I'm like, okay, how far am I from accumulating 10,000 shares? And I looked at my bank and my account. It's not even in thousands. But the point is, I looked at it and I'm said, okay, so this is how far I am from accumulating the 10,000 shares. And I think it puts the price and the movement in the drawer and lets you focus on the shares. And I think it's very helpful.
I wonder if, what if we all had that idea of like, okay, in 20 years, I need 10,000 shares of stock. That's what I have to buy here. So it's like every month, like I'm just trying to buy as many as I can. Every year I'm trying to buy as many shares to get closer to that as possible. And that frame is like, I don't care what the price is. And actually, I even do in that scenario. I would actually want the price to be as low as possible so I could buy more shares. I just think like we don't think about the stock market like that. It's just really the balance of our accounts. But if we did, I think we could save ourselves a lot of headache and worrying about short-term prices.
I love this framing, Jake. We've talked about this on and off before, and I think shifting your mindset to share accumulation versus price is huge. I think the biggest gift / curse of the stock market is its transparency, right? Like I think data shows this across the board in general over a long period of time. The stock market beats real estate as far as returns go. Just again, generally across the board. Rabih can back that up. But where real estate beats the stock market is the inherent built-in behavioral kind of like insulation it gives you, because you don't pull up to your rental property, you don't pull up to your personal residence, you don't see a ticker symbol hovering over your real estate.
Yeah. It's
And
very
because
possible your rental property could have lost 10% this last year and you just didn't even know it.
no clue.
No
No
clue.
idea. So the lack of transparency keeps you in your seat. You don't even think about it, and it feels more tangible. That's why I love, Jake, that you were just saying these are real companies with real people, with real boards, with real profits, with real value
Products.
being added. Like they're real. So when you're thinking about it as like I'm accumulating shares and ownership of these businesses, I think there's a quote from Buffett about this. Like he's just talking about like I'm buying businesses, and now he's actually buying businesses, like as far as like the whole business, but it's no different. It's just on a smaller scale. If you buy some shares of Apple, you are an owner in Apple. So I love that, Jake. I think it's really great framing. Any other thoughts on
Yeah.
any of this?
I love the transparency is often the stock market's biggest enemy. I would say this, just because the stock market is transparent does not mean it's any more dangerous or risky. It's just more honest, honestly.
Yeah.
Right? It's just more up in your face of how things go. And yeah, when the market goes down, you still have the same amount of shares you bought. You're not forced to sell your shares. So if the market goes down, like, hey, I still have, so like in that thing of like, I lost X amount of dollars. Well, you didn't. You still have the same amount of shares. If you're looking for shares because the market goes down, you still have the same amount of shares. You did not lose anything that you've already.
Well, and it's funny, Jake, we were talking to kind of bring this back full circle to our first conversation, our first topic. It is interesting how usually the fear of the stock market coming down, from what I've gathered from people, is usually this doomsday, the stock market's going away scenario. Like, right? Like, because the only true risk is permanent loss of capital. But the only way you permanently lose capital in a well-diversified portfolio in the global market is the global market going away completely. Well, if that's the case, who gives a crap about your 401k? Like, you better have a big gun and some food. But like, maybe what your wife's bringing up right now, but like, we're not living in reality if that's what we're talking about. If we're talking about like the reality of risk, to your point, Jake, although different risks that are inherent within like real estate or different asset classes in the stock market, it's no more or less risky or scary than anything else. It's just more transparent. Like you said, it's more honest.
It's a great argument for diversification, right? It's like if I'm investing all of my money into Tesla and Tesla goes under, the world moves on and things are pretty okay, right? There's other car manufacturing to be okay. But if you're invested in a diversified global portfolio and that goes to zero, then we are like zombie apocalypse
Doesn't
doomsday
matter.
scenarios, right? Where that's why you're
Yeah.
insulating yourself from that. So
Totally. Our 2 cents content would be wild at that point.
would be. We'd have
We're
a great
talking
time.
about a zombie
Like,
apocalypse.
here's the 10 tips of how to build a trench around your house.
Exactly.
Yeah.
Rabih, we're going to give you final word, Master Rabih.
No, I liked it. And since we're doubling down on Warren Buffett and framing, he says something that's very interesting. When you own the shares, so you are already the owner and you see that the market has dropped in price, it's the equivalent of someone knocking on your door and telling you, hey, would you sell me your house for 50% less? And you just bought your house. Like nothing changed in your house. You bought these shares and nothing changed with the shares. The companies are still there. So the price that you see on the markets, on your phone, on the media is not your actual value. It is what the market is saying, telling you, I'll buy them from you at this price. Well, I'm not going to sell them to you until you change your mind and you give me a better price. So that is where we have autonomy. It's the price does not define you. It's what would mean where the decision would happen. And you don't have to make the decision when the market is low.
Love it. Great
That's
final
why we
word.
end with Rabih. Yep.
That's
There
what
we
we
go.
end with Rabih. Guys, that was a lot. We went long today. Hopefully there'll be some, some cleaning up and some editing from our other brilliant team member, Michelle. She's amazing editing these. She's gonna have to maybe clean some stuff up. We'll see. 2 things. If you like this, if this was helpful, and you feel like it'd be helpful for a fellow dentist, we'd love for you to share the show. Share it with someone who you think would enjoy it, who would get something out of this. Number 2 thing would be, just like Rabih graduated, he's now a master of econometrics. I would dare say we have coming up the masters of dental events, which is, that's funny. So I just love Robbie's face when I'm going through these.
I knew today would be challenging for you.
It was
And
hard.
then you brought me into this. Like, why
was
did you
hard.
bring me into this?
It was hard. That was not my best work, but honestly, we would love it. It's coming down to the wire. Dentist Money Summit, June 20th and 21st in Park City. It's going to be amazing. Hundreds of people at this point we're expecting, based on the list that we have. Like-minded dentists just like you out there listening that are just trying to find fulfillment with their money, trying to find more meaning in their money, and get tips and hear lessons about that, and just have a great time. Like, honestly, just have a fun time in Park City. Come meet the team. We'd love to have you out. So dentistmoneysummit.com. For now, thank you so much for listening. Hope you guys have a great weekend. Jake and Rabih, thanks for being here. That was our 2 cents. Till next time. Bye-bye.